All right, hey guys. I know I kind of stopped making videos for a while, and I apologize for that. I'm back, but the thing is, like, basically, I made that video like a couple months ago called "Super Easy Day Trading Strategy," and well, a few things happened. One, the views on that video got suppressed heavily. Somehow, the YouTube algorithm detected that there was something about that video it didn't like, and in my opinion, it's that because the strategy was onto something about the futures market. And I know that sounds conspiracy or whatever, but like, how else do you explain that every time that video was like pushing almost like close to 1,000 views, like it would get halved. Like YouTube would determine that like half my views were bots, and it kept suppressing it and keeping the views at like around 500 or so. So anyway, that was discouraging. That the one time I was posting something profitable, it basically got suppressed. So hint hint, if you're looking for a profitable strategy, go study that video. It's not everything, but it's on the right track to pointing you to the logic system of the market, of the NASDAQ market at least, and how it determines its direction from the open. I'm not going to go more into that strategy or the things I've learned about it now, because at this point, guys, I hate to disappoint you, but I have to protect my edge. If too many people caught onto this edge, or enough money caught onto this, then it could change the edge, or the edge could be lost. I don't know that for sure. It could take a while, but like, just to protect what I've discovered on my own, I can't really unveil more about the strategy, so I apologize for that. But I will say that today was my first day trading a prop firm manually. I tried it before with a bot on NinjaTrader. It didn't go so well because the market wasn't in the right conditions for it. But and then right as I stopped the bot, the market actually entered the right conditions for it, which is funny. But anyway, that system I don't even think was as optimal as this one. That one was just like a bot auto strategy that like does win in the long run, but it doesn't make like a ton of money. Like, it could make a ton of money if you have a ton of capital. But so anyway, I'm starting a trade day thing. I found this because of that YouTube channel called iMan Trading, and he just did a YouTube video exposing ICT as a fraud. And I've already talked about my 2 cents on ICT. I don't believe he's a complete fraud. I just believe that he he's a fraud when it comes to how profitable he is. If he really was as profitable as he says he is, he would show his accounts. And you could maybe say like, well, he doesn't want people knowing how much money he has, so that, like, you know, somebody doesn't come try to rob him or something. But the thing is, he already has painted that target on his back anyway, as being a profitable trader, like as being a known figure. I mean, he makes plenty of money from YouTube, so if somebody wanted to rob him or whatever, like, they already could. You know, he already has that target on his back, so I don't think that's valid. But furthermore, like, if he really was going to show that he was profitable, what he could do is buy a prop challenge and run the account up. He doesn't have to show his entire net worth, but he could just prove that he can run an account up really quickly. And he's barely proved that before. He's only proven it with with paper trading account, and he doesn't show each trade that how it grows. And so again, you can't prove that he's a fraud, but you can prove that he's inconsistent with the results he shows and stuff. And now, like, I must admit, like, a lot of his systems make sense to a degree, but the thing is they don't always play out perfectly correctly, and there's definitely more going on to the logic of the market. And so the system I'm trading is based on some logic that he doesn't really talk about much. He talks about it a little bit, but and it, you know, I'm based on an opening balance, right? That's all I'm going to say. It's opening balance, but it's a little more nuanced than that, and it includes certain candles that most opening balance traders don't look at. That's all I'm going to say. Okay, but anyway, I made my first trade today. I just did their smallest thing, so I got a 20% discount from iMan Trading's code. So I paid 79 bucks for a $10,000 quote unquote prop account, which technically is actually a $500 account because the max drawdown is a $500 lost. So the way you have to look at prop challenges is it's not actually $10,000. It's whatever your max drawdown is. That's how big the account is. But so essentially, while I have to forego some fees and commissions, and also I'm in just the evaluation phase. So my first $1,000 that I make in this, I don't actually keep any of that. That just passes the evaluation. Then I move on to being quote unquote funded, and then I can start making money if I'm consistently profitable, right? But anyway, so $500 a drawdown. Okay, so technically I have a $500 account, less like 10% plus fees and commissions. So really it's like, I think usually with prop firms, you tend to get paid out about 75 to 80% after fees and commissions, and the 10% splitting 90-10 profit split. So after all said and done, you probably take home about 80% of your profits at best, which isn't great. But if you're still a consistently profitable trader, you're still making more money than like you're risking, because I'm paying $79 for a $500 account, which is technically, I guess, if you say I'm going to keep 80% of it, well, then it's kind of more like a $400 account, right? But I have $500 of drawdown, right? That's not a perfect and not like assessment of it, but that's kind of the general gist of it, is like still paying $79 to have $500 of risk and a $400 account is like, that's a net benefit still, right? At least if you don't have a lot of money to start with, and I admittedly, like, I'm not super rich or anything, trading is not, the humble beginnings of trading are not that you come in with tons of money usually. And if you do come in with tons of money, when you first start out, you usually lose it all. So, but anyway, so I took their smallest challenge size, which limits me to 1 mini, which I'm not going to do, but 10 micros. Okay, so $500 drawdown. The rules are I have to be trading at least 10 days. My biggest winning day can't exceed more than 30% of my profits. And if it does, I have to keep trading until it doesn't. And then, yeah, so, and I can only trade certain instruments. I'm only going to trade NASDAQ, obviously during the, when it's open. I don't know actually the permitted times for real though. Let's actually check that out. If it'll freaking load. Anyway, well, 10 minutes before the close. Okay, that's it. So I would have to close positions at the latest by 4:50 p.m. New York time. That's actually good to know. Or well, like basically like 4:49 p.m. before 4:50 p.m. So you can't hold through the close. And if you know this, the real reason for this is that they don't want you to catch multi-day runners. Because they don't know. That just exceeds their risk management. So, but anyway, so today my trade was that I went long pretty much right at the open. I actually got filled a bit. Where's the time? Where the hell is the time? What the fudge? Okay, there's no clock on here, I just realized. That's kind of stupid. I'm going to try to figure out where it is, though. Okay, so I think it's right here. Yeah, so basically I got filled because when you buy, like, look, if I try to buy, see how it does this? Oh, I can do no... Oh, okay, there we go. I'm not going to click that then. Wait. Oh, okay, it actually does work. Okay, I just lost a little bit of money. I was just testing. Okay, so now I can just have one click buy and sell. So that's actually good. That's what I needed. Okay, so now I'm only up $49 on the day. But I started at 10,000. I basically went long with 2 contracts, went into some drawdown, got close to stopping out, took a partial profit somewhere up here, and then moved my stop loss to break even, got stopped out. Now on my paper trading account, actually, I had a thesis that it would... Basically, okay, let's just say this. The place where I'm entering, the optimal strategy, I believe, for the futures market is to take a partial profit and then move stop loss to break even. But some days the algorithm or the market will hunt my stop loss. But I'm okay with that because I already made my profit. But basically there's a signal And today I had the hunch that it wanted to continue upwards after running my stop, but I didn't want to overtrade on this account, right? So basically I didn't get back in the trade on my prop account, but I did take part, or at least I took it. I didn't follow it all the way to the take profit, but I took a profit here because I could see it kind of finding a bit of resistance here. But basically I went long again somewhere in this green, like I'm gonna move this, like it's right around here. I went long again. My stop was like, I think my stop was right here. And then here, I'll just show you the trades. Yeah, so I went long here, closed out of the trade for a small profit because I second guessed it. But then after looking again, I thought, you know what? I'm just going to take the trade on paper. So I got back in at a bit of a higher price, and then I sold up here. I think it will probably keep going higher. So yeah, so I think this is good advice for you guys. If you are doing a prop account or trading live, a good thing to do is, if you have the urge to take more trades, like first trade your profitable system live. Be simple, don't overtrade. Do your, like, you know, your one trade of the day or whatever it is. And then if you get an urge or you have an idea that you think is going to work out, go trade that one on a paper account. Because if you trade that one on paper account, well, you don't make money if you win, but you don't lose money if you lose. But you'll still gain the knowledge and experience and the affirmation of whatever pattern that you see emerging. You know, it's just a good way to trade it. It's kind of a win-win, right? Because that way you'll have a win on your paper account, which is basically R&D purposes, right? Research and development. So if you have an idea for a trade, but you don't know, it's not like completely within your system, but you think it's kind of adjacent to your system, or it's astringent upon your system, sort of like an if-then statement. Like, if this happens during my trading system, I believe that this other thing will happen and this other trade opportunity will arise. Well, take that other opportunity on paper so that you still gain the benefit of winning if you're right, and you learn that maybe it doesn't work so as good as you thought it would if you lose. And so that way you'll just have a better grip on the market, but you won't cost yourself any money. So yeah, sorry, excuse me. So yeah, basically I'm up 50 bucks on the day. It's it's not big, but okay, think about it. If I have $500 drawdown, right? What's $50? What's $50 out of 500, guys? That's a pretty big gain on the account, right? In terms of percentage wise. Exactly. So like, to me, and the drawdown I went through was like, actually I was in bigger drawdown at one point. But there was a chance that it didn't run the stop and that it went for these higher objectives that it's going for without running the stop, right? Some of the days it'll just do that. And those are the days I'm really looking to catch. If it stops me out, that's okay. I'm doing R&D right now on whether I should get back in. And basically this green candle to me was the signal of getting back in. But also after that signal, you could wait for a retracement, like below the low of the candle, or just a retracement down to like 50% of this swing right here. I'm not going to explain why. That's probably not going to make sense to you as to why. I can't explain it. It's my system. But to me, this green candle right here, and also this wick rejection right here, I mean, all I can really say is, like, again, I'm not going to explain why my trade was the trade it was. But just without even knowing my system, right? Without even knowing my system, it doesn't matter. The T-Pre doesn't matter. Okay, but this is where my entry was. So this is where my stop got moved to break even, right? And let's just say, think about this logic. If I have a profitable system with good risk management and like taking partials and stuff, then the algorithm is going to hunt my break even stop, right? So what you have to look for is a sign that your stop was just being hunted. Your break even stop was being hunted. And to me, these two candles right here, because of where my break-even point was, and that's all I'm going to say about it. I'm not going to say why that's where I entered, but the fact that there was a rejection from here and then a nice bullish candle closing, to me, is a signal that it was just running my stop. Now, what they're going to do is they're probably going to turtle soup it a bit. They might not take this low, but they might take this low. So I had a buy limit here, and I also entered here. The buy limit never got filled because, as you can see, my buy limit was here, and I actually think my buy limit should have been here, or like 20. I should have put my like 1 point below, so I should have put a buy limit right here, basically. That's what I have to learn from this. But a buy limit below this low was to me still a pretty smart move, because as you can see, I was correct in believing that even though here it looked like it was going to sell off lower, it was actually just taking out my break-even stop. So it was a good entry, and yeah. Now, I can tell you the reason why I'm bullish today, which is that interest rates. Okay, so let me turn this off. So interest rates, guys. So there's talk that interest rates are going to have to go higher, right? Now, as you can see, also, just another note, see how it went lower below this low, and now it's trading up. Now, it's probably going to trade lower into like this imbalance or even this imbalance. It easily could do that. That's the weekly, so let's go on the daily. But the thing is, guys, it doesn't have to do that, and this is a decent liquidity sweep right here, right? So I'm not saying, oh, it's bullish from here on out, but remember how I called this bull move here? Well, it looks like this bull move here may have just gotten turtle souped, and it could be looking to go higher. Okay, so back to interest rates. Why? So I don't know if you heard, but on Friday, the Federal Reserve said that they may have to increase interest rates. Well, if you know something, retail thinks that higher interest rates mean lower stock prices, right? And remember the inversion narrative? Wait, what the fudge? Okay, I gotta go bigger scale. Okay, if you remember the inversion narrative, retail usually has a incorrect concept about like some fundamental thing, right? And the thing is, with interest rates, what I've deduced, which I can't say this works every single time, but what I've deduced about interest rates is that if interest rates, okay, first let me say the stock market, these stocks are forward-looking, right? So it is forward-looking, especially futures, but it's forward-looking. It's looking to price in what it believes the future is going to hold, okay? So as interest rates are decreasing, stocks will tend to sell off. Big surprise. It's the opposite of what most people think, right? But the thing is the timing is kind of weird, so that it's hard for people to understand. But basically, when the market is expecting to price in higher interest rates, now admittedly this last recession kind of happened weirdly, and it's not usually like that. Usually the interest rates start decreasing and then the market decreases. Here the market started decreasing and then the interest rates started increasing. But the thing is that it did, by increasing interest rates, as you can see, the market started, as interest rates increased, the market started to become more bullish, okay? But the thing is, when interest rates kind of peak, the market tends to start selling off because it's forward looking. So as you can see here, when COVID happened, interest rates reduced to zero, okay? So that alone isn't bullish for the market, but the fact that the market's looking forward saying, okay, interest rates are like zero right now, it's gonna look forward to higher interest rates, right? So it's going to keep moving up until our interest rates hit their peak, right? So it keeps moving up, keeps moving up. Now there is a pullback here, or a recession of a sort, a minor recession, while interest rates actually start increasing. But it didn't last very long, as you can see, as interest rates increase, the market is pricing in higher interest rates. And so because the Fed said they may have to increase rates, I believe the market is actually pretty bullish right now. Now, I'm not a professional. I can't say for sure it's that consistent. But if you know about what the interest rates have done, they slowed down the rate of increase. They didn't start decreasing rates, right? Here, they were increasing them by 25 basis points. I think usually, maybe there was a 50 point, but usually I think 25 basis points per FOMC. And then so around here, they paused. So they did a pause, then an increase. And then this time they paused again, right? So the market's kind of selling off, expecting that pause. But then they said it's going to increase next time. So they've gone from doing every FOMC to basically every other, they hike it, right? Which means they're slowing down the rate, but people are still looking forward to higher interest rates. So that's why I believe the market's bullish. Now, once interest rates start decreasing consistently, I would say then the market looks kind of bearish for the short term. Now, that's not I'm sure there's more going on than just that, but I have noticed the correlation is that when interest rates are low but going higher, the market goes higher. When interest rates are high but going lower, the market tends to go lower. Now, it won't always be perfect, as you can see. You know, sometimes the market sells off without that, but as you can see here, interest rates started selling off. It took a while because I guess there wasn't like really maybe it's because there wasn't a clear direction in interest rates. But this made it very clear, right? So as the interest rates sold off faster than expected, or not sold off, but as they decreased faster than expected, the market had to rush to catch up to it, sell off. As soon as interest rates hit zero, the market, well, interest rates can't go any lower. So the market can't go any lower because it's priced in zero to 25, you know, it was like 0 to 0.25% interest rates. So once it's done that, it's going to look forward saying, okay, interest rates can't go any lower. So that means they're eventually going to go higher. So the market begins to price in higher interest rates, knowing that eventually they will go higher, right? So I'm not perfect at this, and you know, that's kind of very general, but if you look back in history, that's kind of what happens, right? Let's see, go back further. So as you can see here, like right here is a perfect example. 2011, there's the Fukushima thing. Look, actually, I'll go back even further. Interest rates start decreasing. The market starts topping out. It kind of sells off, sells off, sells off. Once interest rates hit a low and they start trending away from it, as you can see, institutions start preparing to buy and move price up away from low interest rates. I don't know what they were here because this does a weird percentage-based thing, but as you can see, and then interest rates kind of look like they're peaking. The market sells off a bit preemptively. You know, again, maybe there's insider information or whatever. And then here, yep, they're peaking, and it kind of buys up. You can see it's moving pretty slow, right? Very sluggish. Once they decrease, see how interest rates here decrease, it starts moving faster, right? Now, you could say, well, why did they sell off here? It's hard to see. It's like, it's weird. Okay, why did they sell off here when there was a spike? I can't say for sure, but it may have been because markets were believing this would be a high, and so it sold off. Again, I don't know. There's stop runs. Again, it's more nuanced than that. But as you can see, as interest rates began to trend up still, the market decided, hey, that's not the high. Interest rates are going to go up, right? So, and as you can see, so annoying, whatever. Okay. So it's one sometimes leads the other. It's not always the same one. And again, that kind of makes sense because if it was that easy, then everyone would probably make money, right? But usually if the market crashes, interest rates will decrease. If interest rates decrease, the market will usually crash, right? But once interest rates hit a low, the market will begin pricing in higher interest rates and it will start increasing again, right? So it's not a perfect correlation, but I'm definitely onto something with that, right? As you can see, look, during the subprime crisis, as it was building up, you know, the prices were moving higher. Look right here. Here's a perfect example also. Interest rates are decreasing, the market crashes. Interest rates hit a low, the market begins to increase, right? Interest rates hit a peak, they begin to decrease, market sells off, right? Okay, see the correlation? It's not always going to be picture perfect every time, but in general, there is a positive correlation between interest rates and the price of the NASDAQ. So anyway, I kind of droned on about that for a little while, but I'm sure this information will be useful to you. So I think it was worth the patience. And yeah. If you want me to give you a long-term investing strategy, I found some really good ones. And you want to know like the easiest one, like if you're okay for waiting years before entering, or like you can enter at any time, but if you're like in terms of adding more to it, what I found is that one of the best ways to get an entry is to have the 200 EMA on a weekly chart. Every time price moves below the 200 weekly EMA, just buy. It's okay if it sells off more. And if it goes below and then a month later it's still below, buy more, right? Now, of course, that doesn't catch every buying opportunity, and you probably want to buy more here, so you might want to go on the daily 200, right, and try to catch more opportunities, which also works. But you know, you'll go into drawdown at sometimes on some of your positions, but it does give you some pretty good entries. But you know, people diss moving averages, but they're actually very simple, and simple is good with trading because it helps you. It just helps with bias better. Coolamaji uses literally these 3 moving averages. He also uses the 50, but you don't have to. And obviously here, below the 200, you might have been buying a lot, but you'd be back to like kind of break even on most of those positions, and you would have added more here, so you'd still be in profit. But again, it's like, if during this recession, you know, I can't say when you should sell out of your position. Maybe like a red candle closing below the 20-week moving average. So like basically like there or here you would have sold, and then you wait to get back in below. And this isn't going to work perfectly for every situation, but I'm just saying, if you'd waited for price to close below the 200-week moving average, or even just touch below it, let's say you just buy here, you buy here, okay, September, then you would buy again more in October. December goes back below it. If you just bought there, here, here, and here, you would have like made a lot of money. Let's be honest. So, you know, it's actually pretty simple, guys. So yeah, I've got some other stuff I found recently too, but I've wasted enough of your time, so I'm not going to get into it. But yeah, I mean, obviously, the way the wind looks like it's blowing, and remember, looks can be deceiving. It looks like the market wants to sell off, but it did just sell off for, you know, it sold off for like half of July, all of August, or half of July, like 2/3 of August, bought up for August, sold off again in September, but and it could, it very well, you know, expect it to keep selling off, you know, but I think long term it is bullish, and there's a chance that we see that even right now, like it could be, this could be the pivot point. Probability says no, but the fundamentals to me say maybe. So yeah, take care, guys.